Welcome to Monday morning's episode of Crypto Macro Insights. I'm Maya, and it's Monday, September 15th, 2025, 7 a.m. Eastern. Tom, we're opening this critical week with Bitcoin holding firm at $115,210, maintaining its extraordinary 39.5% gain over 6 months from $82,563. Our weekend analysis confirms the dramatic liquidity shift continues. Reverse repos down to $17.33 billion, representing an 80.6% collapse from March levels. What's particularly intriguing are the internet voices we're monitoring, mixed signals between cautious optimism about September not being as bearish and growing nervousness about today's FOMC meeting. With the VIX still compressed at 14.71 and institutional liquidity deployment accelerating, Tom, how do you read this setup as we enter what could be a defining week for crypto markets?
Maya, this Monday setup is fascinating from a positioning perspective. Bitcoin's resilience at $115,000 after Friday's close shows institutional conviction, but today's FOMC meeting introduces critical uncertainty. The reverse repo collapse to $17.33 billion means we've seen $104 billion in forced liquidity deployment over 6 months, money that cannot earn Fed fund rates when cuts are anticipated. Here's the key insight. Internet voices expressing nervousness about FOMC, while simultaneously noting September isn't as bearish as usual, perfectly captures this moment. They're recognizing the seasonal pattern break, but remain anchored to traditional Fed-watching behavior. Maya, with only $17.33 billion remaining in reverse repos compared to March's peak, we're approaching the mathematical endpoint of this liquidity supercycle. Today's Fed decision doesn't just impact rates. It determines whether the final $17 billion accelerates into risk assets or gets recycled through traditional channels.
The internet voices we're tracking show an interesting evolution from Friday's fatigue to Monday's cautious optimism. There's talk about time to buy more BTC and ETH and speculation about ETH reaching $12,000 to $15,000 by year-end. How do you interpret this sentiment shift over just a weekend?
Maya, this weekend sentiment shift reveals the classic retail psychology pattern. Friday's hard to get excited becomes Monday's time to buy more. This isn't analysis, it's emotional oscillation. Meanwhile, institutions have been systematically deploying the $104 billion in reverse repo liquidation regardless of weekend mood swings. The internet speculation about ETH at $12,000 to $15,000 by year-end shows retail is starting to extrapolate current trends, always a late-cycle behavior. What's crucial is that these sentiment shifts occur while the fundamental driver, forced institutional liquidity deployment, continues mechanically. Maya, retail sentiment provides noise, but the $17.33 billion remaining in reverse repos provides signal. When institutions need to deploy this final tranche and retail voices are oscillating between fear and greed, you get optimal conditions for the next acceleration phase.
With Bitcoin at $115,210 and all eyes on the Fed today, what are the critical levels traders should be watching?
Maya, we're seeing beautiful convergence between technical and fundamental factors. Bitcoin's 39.5% 6-month gain has brought us to a critical inflection point at $115,000. From a technical perspective, this level represents the psychological barrier before potential acceleration to $125,000 to $135,000. Fundamentally, the reverse repo decline to $17.33 billion creates mathematical pressure for continued deployment. The key insight is that today's FOMC decision operates against this backdrop of forced institutional flows. A dovish outcome could trigger the final $17 billion deployment and push Bitcoin through $120,000 resistance. A hawkish surprise might create the healthy correction that institutions need to complete accumulation. Maya, either scenario serves institutional interests. Dovish accelerates deployment, hawkish creates better entry points. Retail traders watching for Fed reactions are missing the larger liquidity supercycle that continues regardless of today's announcement.
Beyond today's FOMC, we have retail sales tomorrow and industrial production data. How do these economic releases factor into the crypto narrative?
Maya, this week's economic calendar perfectly illustrates why Bitcoin has become a macro asset. Tuesday's retail sales and industrial production data will influence Fed expectations for November and December meetings. Strong data supports higher-for-longer rate scenarios, potentially slowing reverse repo liquidation. Weak data accelerates cut expectations, forcing faster deployment of remaining funds. The beautiful irony is that internet voices worry about individual data points while missing the systematic flow dynamics. Whether retail sales surprise high or low, institutions still need to deploy the final $17.33 billion. The question is timing and price levels. Maya, traditional economic analysis asks, what do the numbers mean for growth? The correct question now is, what do the numbers mean for institutional flow timing? This perspective shift explains why Bitcoin maintains resilience even when individual data points disappoint.
Given this setup, how should investors approach this week strategically?
Maya, this week requires patience and mathematical thinking rather than emotional reaction to individual events. Bitcoin's position at $115,000 after a 39.5% six-month run creates specific risk-reward parameters. The disciplined approach: use any FOMC-induced volatility as positioning opportunities rather than directional bets. If dovish outcomes push Bitcoin toward $120,000, that's healthy progression of the liquidity deployment theme. If hawkish surprises create correction toward $108,000 to $110,000, that's optimal institutional accumulation territory. The key insight is that both outcomes serve the same underlying narrative: forced deployment of the final $17.33 billion in reverse repo funds. Maya, internet voices will react emotionally to today's Fed decision, but institutional flows operate with mathematical precision. Position for the flow, not the news. The greatest risk isn't Fed policy. It's missing the systematic wealth transfer occurring regardless of individual announcements.
Critical Monday setup in summary. Bitcoin opens at $115,210, maintaining its 39.5% six-month surge as reverse repos collapse to $17.33 billion, down 80.6% since March. Today's FOMC meeting operates against backdrop of systematic institutional liquidity deployment, with only $17 billion remaining to be deployed. Internet sentiment shifts from weekend fatigue to Monday optimism, but institutional flows continue regardless of retail mood swings. Key insight: both dovish and hawkish Fed outcomes serve institutional accumulation interests through different mechanisms. This week's economic data: retail sales, industrial production matters less for growth implications than for institutional flow timing. The mathematical endpoint of this liquidity supercycle approaches as forced deployment accelerates. For crypto macro insights, I'm Maya. Stay focused on flows over news, mathematics over emotions, and remember that the greatest opportunities emerge when systematic forces overwhelm individual event reactions.